Hi guys, Max here, and this is your daily update for yesterday, the 21st of January. Of course, I have been gone for a few days now. I missed a few updates, and unfortunately, it couldn't have come at a worse time as the markets have been pretty awful. Yesterday, this trend, of course, continued, and actually it got worse. Markets were, of course, open. Crypto markets were absolutely manic. A load of tech stocks got hit really hard as well. 15 to 20% drops for some big names as well. Really, this was a big crash in a lot of assets, and it's worrying a lot of people. Now, of course, that is mostly what we're going to talk about today, but we are, of course, going to touch on a couple other things as well. I'm also thinking about putting together a few videos explaining what's going on in particular with some of these stocks that have tanked, or rather are still tanking. So if you want those videos, let me know in the comments down below. So now, to start off, what happened in the broad markets? Well, it was a sea of red. Stocks as a whole, and pretty much everywhere really, fell, and they fell by quite a lot. Tech shares, of course, bore the brunt of the collapse, as is all too common these days, but plenty of value companies fell as well, and not by small amounts. The S&P 500 as a whole fell for almost 2% on the day, which was far from nice. The index is now sitting below its 200-day moving average, which is a worrying indicator for a lot of people, and it's suggesting to a lot of people that we are now in a bear market. Of course, there are lots of different ways to define a bear market. Usually people consider a 20% decline to be a bear market, but personally, I'm not a fan of that definition, as to me, a bear market should be the direction a market is moving in, not necessarily how far it has fallen so far. Also, to everyone saying that there is a definitive definition of bear market, that's just not true. It's just not the case. Language is subjective, words change meanings and evolve every single day, and there is no word or phrase out there where everyone agrees on its meaning. Now, for the other indexes, the Nasdaq, of course, being tech heavy, took another major tumble, down 2.7% for the day. It's now seen a 13% negative return this year so far, which is its worst performance in years. As I said earlier though, the pain has not been limited to just the tech world. The Dow Jones fell a whopping 1.3%, and a lot of foreign indexes fell as well. The FTSE 100 was down 1.2%, the Nikkei was down 1%, and the MSCI World Index was down 1.8%. Pain and red all around, it seems. The US dollar had an okay day with its spot index falling 0.1%, the pound fell 0.3% against the dollar. I also thought I'd just very quickly explain that despite the fact that I am British and I do live in the United Kingdom, I mostly work with American companies. Most of my audience is American, and I mostly get paid in US dollars. Really, that's just how everything works out. But that means I actually make more money when the dollar is strong and less money when the pound is strong. So this weird idea I've seen in the comments that I'm just rooting for the destruction of the US so that I can get richer really doesn't make any sense. Now, bond yields actually fell. The US 10-year Treasury yield fell by 5 basis points, though it is still sitting relatively high at 1.76%. WTI crude oil fell 0.7% for the day, but that was after it ran up a load on the days prior, so it's currently sitting at about $85 a barrel, which is still really high. Gold also fell about 0.7% for the day, but again, that's also after it rose in the days prior by far more than that, so it's currently sitting at $1830 an ounce. Now, cryptocurrencies had an absolutely awful day, with pretty much everything falling from 10 to 25%. At the point of me making this video right now, Bitcoin fell about 15% for the day, and it's sitting in the $34,000 range. Ethereum fell more than that for the day and is sitting at the $2,300 range. Before I went away and took some time off, Bitcoin was sitting at about $43,000 and Ethereum was at $3,300. So when I woke up this morning and had access to the internet for the first time in 4 days, and I checked the markets and saw everything sinking this low, I really had to make a double check I wasn't still asleep. Of course, the rest of the markets followed Bitcoin, as is all too common. Cardano was down 11%, Solana was down 14%, Binance was down 13%, Luna is down 18%. It seems that there really was no respite. The entire crypto market took a major hit, and over $1 trillion of wealth in cryptocurrencies has now been erased this year. We are very close to Bitcoin being at 50% of its all-time highs. It may even be at this point right now while I'm writing this video because I don't have the live price behind this screen. I believe at $34,500, Bitcoin will be at 50% losses. And I know some people will say, well, they bought back in 2019, so they're still in profit or whatever. But the vast majority of crypto investors out there did not buy in 2019. And they didn't buy in 2020 either. They bought when the markets were sitting above $60,000 and now they're seeing huge losses. No, this is not good news. It's really bad for the crypto markets. The crypto markets are now in a bear market, not quite crypto winter yet, I wouldn't say, but there's no positive way to spin this. So why is everything collapsing and crashing and turning red? Well, part of it is, of course, the fear of higher interest rates and a tougher investing environment. We've been talking about that for months now, but a big part of it and what's new and what probably actually triggered this crash was shaky earnings and growth reports from a bunch of companies that has really scared investors into thinking that the companies and the assets they own are not safe and not as great as they thought. This is very similar to a tweet that Michael Burry put out some months ago, where he pointed out that earnings prior to the 2008 financial crisis were really high, and everyone was wondering how the stocks managed to crash when earning expectations and forecasts were really strong. Well, it's really simple. Those forecasts turned out to be wrong. They changed, and suddenly prospects weren't so good. So forward PE ratios collapsed overnight, for example, and then the stocks followed that crash. And that seems to be what's happened over the last day or two with companies like Netflix today. Of course, there are also tensions over the Ukraine, and they are not subsiding. They're actually getting a little bit worse, and that is probably worrying a few investors as well. But I think the real key thing here is the earning reports from a bunch of companies. We're getting more reports from some other big companies like Apple and Microsoft later in the week. And that's really what we need to be focusing on. Now, this idea of big tech companies in particular not doing as well as the market expected them to be doing really shouldn't be surprising to us because it's what we've been predicting for months now. Looking back, a lot of people who ignored all of the warning signs will tell you that it was obvious, just not obvious enough for them to pick up on it at all at the time, but we did pick up on it. I haven't had a chance to look at what Meet Kevin is saying at the time, but his big picks for the last year, Pinterest, Peloton, those sort of companies that have been getting absolutely hammered recently were some of his highest conviction stocks where he was telling everyone to buy and he was buying them himself. Of course, I think it's important that we hold people accountable for what they said in the past. If they said that it was a bull market forever and they turned out to be wrong, they should be picked up on that, and Meet Kevin shouldn't be any different. Now, one of the most important metrics that we've been looking at, that we've picked up on this channel, has been consumer confidence, which has been sitting at rock bottom levels. Now, pretty simply, this is a measure that determines how confident consumers are in the economy, in their ability to earn money, to pay their rent, to live comfortably, and people just aren't confident about that at all. This in itself will impact earnings of lots of companies. If your consumers are worried about paying their rent, then the first things they're going to stop paying for are subscription-based services that are overpriced and underused, like Peloton. Netflix as well raised prices again due to inflation, and now they're not seeing as many sign-ups as they had hoped, which is bad for their future growth prospects. Apple, over the last few months, has been telling everyone that they're not going to sell as many iPhones as they were expecting, a clear sign that consumers are just going to be spending less. And yet the market just ignored this news and these forecasts for months on end, and now suddenly all of these investors are surprised that Apple is down 10%. The Nasdaq, of course, being the home of every overhyped tech company with too many promises and too few achievements, has been hit very hard. And we've spoken in detail about how the index is being carried by the 5 largest stocks, but even those companies are now starting to struggle and take hits. As I just said, Apple is down 10%, Tesla is down 20%, Nvidia is down 30%. All of these companies, those are declines from their all-time highs. The Nasdaq as a whole is currently down about 14% from its all-time highs, and the sentiment around everything seems to be very bearish. We're now at the point where $1.7 trillion in wealth has been erased from Nasdaq stocks so far in 2022. That's over 20 odd days. And if this trend continues, or rather, if it even just doesn't reverse, then January is set to be the worst month for the Nasdaq since the 2008 financial crisis. Shopify is another one of those companies. That is a great business. It's moving well, growing and expanding and building revenue, but it was just insanely overvalued and is now down over 45%. Of course, that isn't all bad news for investors. While the likes of Cathie Wood and her ARK Invest funds have been getting absolutely ruined, the newer ETF SARK, which basically just shorts ARK-K, is up 50% from its inception a few months ago. I actually distinctly remember when this ETF came out, I looked up on my brokerage to see if I could buy it, and I couldn't. So I actually phoned up the brokerage to see if I could trade it over the counter or something, but it just wasn't something that they offered, which is without a doubt a shame. I would have made a nice tidy profit. To be honest, I really don't know what to say here, except that if you're watching this video today, at least you're on track now. At least you're finally hearing about the reality of the tech bubble that has been building for years now, something that we've been talking about on this channel for months now. I'm also going to say that we should not expect this to resolve itself over a month or two. We should not expect these companies to only go down either. They will rise and fall and move in every other direction as well. Yes, I firmly believe that the trend will continue downwards, but that doesn't mean that there won't be bear traps and bull traps along the way. Bubbles don't pop. They don't crash instantly. They take months or even years to deflate, and the real thing that we should be worrying about is the idea that we could see consistent declines for years where we buy the dips and the dips just keep dipping. Be careful throughout all of this. Don't jump 100% in head first. Mitigate some of your risk. Work out how much risk you can tolerate and invest accordingly. Of course, the same sort of thing has been happening with crypto as well, with over $1 trillion of wealth disappearing in that market. It seemed like just yesterday that Bitcoin was sitting above $60,000 and everyone on YouTube and Twitter was calling for 100k Bitcoin next. And really, this just shows you how important it is to try and seek out alternate views on investing, especially when it's in a really volatile asset class. That maybe means listening to a pragmatist like me, maybe a perma-bear like Peter Schiff, and then maybe a perma-bull like Meet Kevin. See what everyone has to say, see what makes sense to you, see what actually follows logically. Don't just take one man's opinion as gospel and act surprised when they can't predict the future with 100% accuracy. Now, unfortunately for those moon boys, the people who really just wanted something to take them to the moon and make them rich forever, meme coins in the crypto markets are struggling, of course, because their value is almost entirely dependent on drawing more fools to the market. And when prices go down over a long period of time with loads of negative news, no one wants to join those markets. Dogecoin, Shiba, and Floki are all struggling, and that of course isn't going to change, especially while we're in a bear market. Coinbase as a company is of course struggling as well, as its highs and lows are often connected to the crypto markets, to how much people are trading, how much money they're making and losing on margin calls and things like that, and things are looking very poor indeed. That's actually another company I've been thinking of putting a quick video together, looking into why everything has gone south for them. So if that's something you want, then let me know in the comments down below. Jeremy Grantham has of course been calling this all a bubble for a long time now, and I've actually made a video, or I think actually I made 2 videos on this. Links for them will of course be in the description. But he's basically come out and said that this is it. This is the start of the sell-off, or the sell-off has already started and the bull market has ended, the bear market has begun. He has been calling bubbles and market crashes for decades now, and it looks like he's just done it successfully again. Now, in Ukraine news, not really financial news, but geopolitics, and certainly something that is weighing on the minds of lots of investors around the world, tensions are not getting any easier, they're not getting any lighter, and some Western nations are actually starting to make a bit of a stand. British armed forces have sent over hundreds of NLAWs, which are some pretty solid handheld anti-tank weapons. British and American special forces, Americans the really important bit there obviously, they have landed in Ukraine. They are in the country now. The Dutch government have come out and they have said that they have both the capacity and the will to enact strict sanctions on Russia should the country be invaded, which is great to hear that they're growing some balls. Biden did slip up and accidentally say that he wouldn't respond if there were a light invasion of Ukraine. But let's be perfectly honest, that's because he just isn't compartmentous, and his administration quickly rectified his mistake. The only problem here seems to be with Germany, who is proving to be as cowardly as ever and announcing that they will not help to arm Ukraine to protect themselves. It's even gone as far as British and American planes that are arming Ukraine aren't being allowed to fly over Germany to do so. This is complete, utter cowardice and nothing more. I know that lots of people were worried about the decline of Germany's authority as Merkel stepped down, and I worried about that a bit too, but I really didn't think it would go this south this quickly, that they'd have a complete lapse of moral judgment and integrity, and we'd see them behave like scared children. This is, of course, another sad day for Europe, it appears. Now, I mentioned in the videos a little bit that I'm thinking about putting together a few quick videos explaining what's happening to some companies like Peloton, Netflix, and Pinterest. You know, some of these companies that have been crashing. So if that sounds interesting, then let me know what you think in the comments down below. If you want me to take a look at a specific company like Shopify, just give my 2 cents, then say that in the comments as well. That is it for the day. Of course, I'll be back tomorrow to give you another update, although markets will be closed. If you enjoyed this video, then leave a like and a comment to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my own portfolio and buy and sell alerts for all my own investments. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. It's completely free to sign up, you don't have to buy anything, you don't have to hand over any card information, so if that sounds interesting at all, then make sure to check it out. There's also a link in the description to BLOCKFI, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USDC, which is a far higher rate than you'll get from any savings account these days. Just make sure not to use Tether. Thank you all for the support. Thanks for watching. Stay stoic. Until next time.